Good afternoon and welcome to the Covered Options Online Learning Club, also known as the Cool Club. I'm Paul Madison and I'm your host for the Cool Club. Again, if you want to contact me, you can write to me at the Cool Club discussion list, which is cool_club@bivio.com. Again, our disclaimer about options. Options do involve risk and are not suitable for all investors. All investment club members and individual investors should understand the risks of any form of trading or investing. To learn about options, we recommend visiting the Options Learning Center at the CBOE. To learn about stocks, you could also visit lots of places, but one of them that we recommend is the Investor Education area of the NASD, the NASDAQ. All right. Quickly, what is Cool Club? This is our weekly 30-minute session where we'll explore the thought processes associated with actual covered options trades. Most sessions will walk through one or two trades from the recent past, going through the logic on why we are looking at a particular option on a particular stock. We'll often look at both when the trades were put on and come back and look again at them when we close them. We're trying to close them. Tonight we'll be using the cash secured put Cool tool that was introduced last week, but we'll be using it to look at closing options. Here's the September schedule for the rest of the month, along with projected topics. No guarantee that we might not change things, but our intent is we'll talk about closing cash secured puts tonight. And then the next 2 weeks we're going to be talking about selling covered options, both calls and puts, on broad market indexes, so like SPY and the IWM. We'll have a new Cool tool for that we'll release next week. We'll talk about opening options next week, and then the following week we'll talk about closing options. And then finally, at the end of the month, September 26th, we'll have a session dedicated to that rascally Mr. Volatility and spend a little time talking about and looking at volatility. Something that I've put off talking about, but it's probably time. We're continuing to build out our Cool Club homepage. The link is bivio.com/cool_club. Handouts and recordings are under the presentations list. You can join the email discussion list here. You can get the Cool tools that we've talked about for the last few weeks under resources and tools. And finally, the schedule and registration links are under meeting dates and times. So tonight we'll do a little bit of a refresher of what it means to close a cash secured put. Then we'll look at how to use the Cool tool for cash secured puts, closing cash secured puts, and actually walk through several examples, or at least as many as we have time for, as we've had several additions through today's discussion list. So we'll try and hit as many of those as we have time for. All right, so let's get into cash secured puts. Kind of a little reminder again about covered options. Remember, our mindset's different when we are doing covered options. When we are dealing with stock, we always start by buying, and then at some point we probably will sell the stock. Sometimes we have a hard time getting to the selling side, but that's the natural progression. When we are doing covered options, we have to kind of think backwards. We start by first selling, and then, as we're going to talk about tonight, we have to close the option, which often means buying. There are other ways, but buying is one of the options. One of the ways, excuse me. And again, this is our little mnemonic that kind of help us remember that calls can turn into sells, and of course this week we're talking about cash secured puts, and they can turn into buys. So that just kind of helps you remember what calls might mean to you as a fundamental trade and what puts might mean. So first, the two ways that we could close an option is just leave it open until expiration date. If we do that and the stock price ends higher than the strike in the case of a put, then it will expire worthless and you get to keep all the premium collected, and all of that will be considered short-term capital gains. If it's a taxable account, of course, IRA, then that isn't relevant. Your cash is freed up, so you can then do whatever you want with that cash. You could go buy stock if you wanted to, or you could sell another cash secured put against it again on that stock or a different stock for that matter. So your cash is freed up. You're no longer obligated to be buying stock. If the stock price closes below the strike, then your option will be exercised, meaning that you will have bought the stock at the strike price. Your cost basis is going to be equal to the strike price less the premium you collected when you sold the cash secured put. And obviously, in the cost basis, you add any commissions you paid on either side on the stock being put to you, which is called an assignment charge by some brokers. Some brokers like Fidelity and Schwab, the assignment cost is just a normal stock trade cost, so like $7.95 or $8.95. The brokers that have an actual assignment fee sometimes are quite a bit higher. So I've seen or heard about as high as $20. So those commissions, as well as any commissions you paid when you sold the option originally, would be added to your cost basis. The last way we can close a cash secured put is to do something ahead of expiration, and ahead of expiration actually includes while the market is open on the day of expiration. And the action here is to close the open position. And since we started by selling first, what we have to do to close it is a buy to close. So what does it mean to buy to close? As we said, that means we can close our option before the expiration date. We turn around and become a buyer of the same option that we sold. We would be paying a premium rather than collecting a premium. By closing the position, we retain our cash, and we are no longer obligated to buy the stock that we had the put on. We get to keep the difference between what we collected when we sold to open and what it cost us to buy to close the position. And if this is in a taxable account, that difference would be viewed as short-term capital gains. This is real similar to the calls. To determine when to buy to close, there's a couple different ways that people do it. There's a simple target, which is based on a certain percent of the original premium. In my example here, I've used 20%. So when the premium drops to 20% of the original premium collected, that'd be a point that you could buy it back. So what does that mean? Well, if I sold to open $1, I might consider buying it to close if it got down to 20 cents. Maybe it needs to be a little lower than that if we want to try and do it net of commissions, but that kind of range. But as I mentioned on the calls, I also like to take the time component into account. So I actually look at the APR of what is left on the remaining premium. And if that drops to an APR of less than 10%, then I don't view it worthwhile to leave the option open to get that last remaining amount. And sometimes that can be quite a bit. I might have sold to open at a 30% APR one day, and by the next day it fell down in half, and the APR that's left, because there's still most of the time left, the APR might have dropped under 10%. I will take it off and be quite happy with the gains that I made on the sale. The Cool tool uses a combination of both of these two. In the At the beginning it'll be primarily the time-based, but as you get closer to the expiration date, the simple target takes over. Let's see, Lori, any questions at this point before we move into the tool?
Just a basic question. Would a put be exercised prior to the expiration date?
The general answer to that is no. There's nothing that keeps the owner of the put from doing that. Typically, it's going to be advantageous for them not to do that. They would make more money to go ahead and, if they own the option, to sell the option and then do an outright sale of the stock. But there are the rare circumstances, and it tends to be on stocks where the options are extremely thinly traded, and you might see wide bid asks between the on the options. And in those cases, occasionally it'll make sense for somebody to just go ahead and exercise their option rather than doing a two-step. But in general, puts do not get exercised early. That's not to say that they can't be, but it's a pretty high percentage that they are not. That you don't have the situation that you have on calls. On calls, when somebody owns that option, they may want to go ahead and buy the stock so that they can get the dividend early, where you don't have the opposite situation on puts. No one is going to purposely sell you their stock just to make sure that they avoid getting the dividend. That doesn't happen. So dividends don't come into play, and so in general, they will not get exercised early. Okay, so with that, let's move into the cash secured put cool tool. Reminder, they are Excel spreadsheets. They work on Windows versions of Excel. They do not work on native Excel for Mac. They would work on, if you're running a virtual Windows, either Parallel or VMware Fusion on the Mac, where you can actually run Windows Excel, that'll work. But Excel for Mac right now, they do not work. Again, to use the cool tools, you'll need to make sure that you allow macros so that the macro that just resets things, clears all the data, works. You'll also need to be enabling data connections so that it can go out and get quotes. The tools, if you have the latest, will open up on the Getting Started sheet. That is where you would input the commissions for your broker. And once you save it on your machine with that, those will stay the same, so you don't have to update that every time. And then when you're ready, you would click on the go to closing the option is where we're going to go. A reminder on where you can get them, tools and resources and tools, and you can see there's a link for the cash secured put cool tool, and Lori may already have it here, but the presentation from last week will get posted and will be under the cool tool as well to go directly on to the presentation that talks about the opening of options, and then tonight's will also get posted there. Before we go straight into the tool, I thought I'd work through some screenshots of closing of the coach put that I was looking at from last Friday. So, and again, a reminder, all of our examples strictly for education purposes. We are not making recommendations on either stock or options to buy or sell either one. And again, before investing, you need to do your own research and or consult a professional. And so now we're looking at a screenshot. This is from what I was working on last Friday. And before we get into the details of it, I just wanted to point out we did do a small update, and the latest version of the cash secured put cool tool is version 2.06. So if you have a lower number, like 2.04, then you need to go get the latest. It'll fix a couple small things. The covered call tool is still just version 2.04, but the cash secured put is 2.06. All right, so last Friday, August 31st, about middle of the day, I was looking at buying back the coach put that we had put on last week, at the last Cool Club, I'm sorry. So it actually was sold on August 23rd, so that I think it got filled the day after the Cool Club session. And it was a 52.50 put. I sold that for $1.25. I only did one contract, and as I said, the date was August 23rd. So the Cool tool tells me I need to be collecting 20 cents is kind of the maximum premium that I'd be recommending. And again, that's the combination of being either below a 10% APR or the 20% of the original premium that was collected. This is based on using the our virtual trading system's commission rates or commission schedule. So it's the $14.95 for the first 10 contracts and $1.50 after that. As just a quick sidebar, excuse me, I want to show you what happens if your commission schedule is different. So I put in Fidelity's commissions. All the information is the same, except you can see my base is $7.95 and then 75 cents per contract. And Fidelity's base doesn't cover any contracts in the base. And now notice that our maximum premium that we can pay actually bopped up by 6 cents, and that's because the commissions are so much lower. So commissions do affect these significantly. The other thing that will affect it is the number of contracts, and we'll play with that a little bit when we're running some examples later. But so commissions affect it, as do the number of contracts. And because the virtual trading system has such high commissions, you can see it actually can amount to a fairly significant portion of that maximum premium, almost a third in this case. Okay, so we'll go back to our higher commissions and our 20-cent premium. If we click our option chain, that pulls up our Yahoo page. And something I haven't mentioned before, but the when you're looking at an option, so in this case our 52.50, notice that the symbol is blue, and if we're at the web page, you'd see my cursor turn into a finger, and it says it's a hyperlink. And if we click on that ticker, it will actually take us to an option, quote, detail specific for that particular option. So you can see we're now looking at Coach September 2012, 52.50 put, and it tells us where it closed yesterday, tells us what the very first trade that happened today was. So the first trade was 41 cents, and it also tells us the range for the day. So on this particular day, this was August 31st, it had traded between 41 cents and 55 cents. Current bid ask was 55 at 60, and you can see 55 was the last trade. That's useful information, so I just wanted to make sure you knew you could get a little more detail than what shows up on the option train itself. And like I said, it's by clicking on the ticker symbol for the option. All right, so with that information, and even though the option wasn't down to what I'm recommending as a maximum premium, I decided to play a little what if. What if I did buy it back at 40 cents? And I do this because sometimes this is real interesting. So in this case, I thought I might be able to buy it back at 40 cents. And my Cool tool tells me I'm essentially netting about half of what I originally had collected. I had collected $110, but by buying it back, I'd be spending half of that, $55. And so that means I would be cleared $55 in a time frame that was just a little more than a week, about 8 days. So I mean, it's a really nice APR. It's a 44%. And what I then need to ask myself is, okay, if I've done that, how much time is left? Well, there's a little over 3 weeks left. And my real question is, would I want to hang around for another 3 weeks to get that last $55? Now, it hasn't gotten down to the point of a 10% APR, so you can hang on longer if you want to. But there may be times where you say, well, you know, in this case, the stock has moved up fast enough. I may want to just go ahead and take the profit that I have, move on, and that releases my cash, frees it up. And in the case of cash secured puts, when you release that cash can be available to sell puts on any other stock or even a broad market index. So unlike calls, when you take a call off, you still own your stock and you'd have to sell a call again against that stock. But in this case, you now have cash and you can sell cash secured puts on anything that has options available out there. So the pretty large ocean of fish, if you will. So there are times when you might say, I'm going to pocket my $55, buy this back, free up my cash, and move on to my next opportunity. And in this particular case, I decided to do exactly that. I put in a buy to close. Here was the order. So buy to close to buy the coach put back at 40 cents. It was a good to cancel because I wasn't going to be in the market on Tuesday. And lo and behold, it stayed open all day Friday, and it actually stayed open all day Tuesday, and it never did get to that 40 cents, so it was not taken off. And so we're going to go look at where it is now and decide if there's something we want to do. And we'll do that in just a second. So here is our tool. We'll put our coach in, and our expiration was 9 of 22. Strike was 52.50. We sold to open at $1.25. We did one contract. Date sold was August 23rd. And now you see, because we're almost a week later than when I looked at it, or I guess not quite a week, 5 days later, that maximum premium has actually dropped to 12 cents instead of the 20 cents. So next we can hit our option chain and just say, well, what's available out there? When we do that, and we remember we need to go down and make sure we're looking at the puts, we can see that today the 52.50s closed. The last was 42 cents, and the bid and ask were 40 at 45. And so it's about the same place, but that's even further away from our maximum bid. And we've now knocked 5 days off of the option expiration. If we put in the 40 cents, we're in the same situation where we would be netting about half of what we originally collected if we took it off. But we now have been on for 13 days, and there's 17 days left, so now it's almost equal on kind of how much time we got the first half and how much time there is left. Maybe I'm willing to wait a while longer. Maybe I'll get an opportunity for it to dip. So I don't know that I'd be as anxious to take it off today as I would have been last Friday. Okay. So at this point, I haven't put an order in to buy it back, and I'll continue to monitor it. So let's do our clear data. And I'm going to start with looking at closing a couple options that we had looked at last week. One was carboceramics. The expirations were the 922s. The strikes, there's a couple strikes we looked at the last session of Cool Club. We looked at the $70, and the premium would have been $265, one contract. The dates sold would have been 723, and so to buy this back, I'd be recommending to try and get below 35 cents. If we check our option chain, scroll past the calls down to puts, and we're looking at the $70, we can say, oops, nope, it's still quite a bit higher. It's actually 320 at 410, so it doesn't look like we have an opportunity to buy back on that. If we drop down to the $65 put, when we looked at that at Cool Club, it was $1.40. This is saying the premium you'd want would be 17 cents. So let's go look at our 65 put. And that's at $1.15 at $1.50. And that's about the same place as we sold it, more or less. And so again, it doesn't look like there's an opportunity at this juncture to be buying that back. Let's see, so that's Carbo. Oh, let's go back in there. I did mess up. So the expiration was September 22nd. The strike was 70, and we were looking at 265, one contract, and I should have had 823, not 723 in there. And so that's a small change here that doesn't really affect the maximum premium that's left, but somebody just pointed that out to me. So this date isn't critical when you're looking at what to do with what's left. What's critical there is the expiration date. It really sets what kind of premium you should be looking to try and buy back at. All right, so the next one that I wanted to do was Ross Stores that we looked at last time. Again, we looked at September 22nd expirations. The strikes we looked at were $70. We looked at the time, we were seeing like $2.20 premiums, one contract. Date sold, we'll get the right date this time, would be 8/23. The recommended would be buying back at like a quarter. We can hit the option chain. And $70 again is 220 at 235. It's still fairly high, and that's because the market's been the same place, if not actually softening a little bit. So puts are going to be going up in value. So it doesn't look like there's an opportunity to buy that back at this juncture. So before we move on to the next, any questions on Ross Stores?
Paul, Itana was mentioning whether you want to explain why the premium was higher for beginners. I'm not sure which trade she was talking about.
Yeah, in general, if your market price on a put, if the stock price stays exactly the same, then as you get closer to expiration, it'll tend to drop in value. If the stock price goes up, the premium will drop. But if the stock price drops, then the put premium will actually go up. So in this case, it's about the same place, and that's a combination of fewer days, but the price has dropped off a little bit. When we were looking at Ross Stores last session, Ross Stores was just under $70. It was $69.60. You can see today's price is about $1.25 lower than that, $68.27. So the price is lower, which would tend to push your premiums up a little bit, but there's also less time, which would tend to decrease your premium. So the combination of those two things kind of working against each other says you're really about the same place you were 2 weeks ago when we were looking at this. So I hope that helps. All right, we've got several that got suggested in the discussion list, but before we go into those, let's drop back over to our slides for a second. So in the slides, I've captured the carboceramics and the Ross store data, so you can be looking and playing with those as well. And then I just wanted to finish the last few slides. I had assigned a homework assignment of selling a cash secured put at the last session around one of these four stocks. So far, I don't think I've noticed anybody post one that they've done. I don't know if that means people are afraid to or whether they don't feel they've seen a good opportunity. But either case, I'm going to leave the assignment open for another week, and I'd encourage you to play with and try and find a time to maybe sell a cash secured put against one of these four companies. FAST, which is Fastenal, PNRA, which is Panera Bread, ORLY, which is O'Reilly Automotive, or ALGN, which is Align Technology. And again, I'd encourage you, if you're new to options, open up a virtual trading account. The homework assignment that was posted a while back gives the details around setting up a virtual trading system account if you haven't done that already. And then, as I said, experiment, try playing with selling one of these. Once you do it, I encourage you to kind of write it up and share with the other Cool Club members what you did, and with this kind of detail, your fundamentals, so what kind of buy price range you were looking for, what strike expiration, the premium collected, when you did it, and what the Cool tool told you your APR was. So again, I think it's a good exercise, good experience, and your sharing your experience will help others as well. As I mentioned before, next week's session, which will be 8 o'clock Eastern, we'll be selling covered options on broad market indexes and using the new Cool tool to do that. We'll be releasing that tool on the 12th. So, all right, so now let's go back, play with a few other examples, or I guess I'd first ask if there's any questions, Lori.
Well, there was one question, and I just threw together a little poll about whether people have used the virtual trading simulator. Just somebody was curious. So
right.
If it's okay, maybe I'll just launch a little poll, and it's just a yes/no question.
Great. And I guess depending on how that comes out, for those who haven't done it, we might, would look for any kind of feedback on why you haven't, if you think it's too hard or you had an issue with trying to open it up, or if there's anything we can help you with, we'd be happy to try and answer questions around it. I think the people who have done it that I've talked to have found it to be a very useful exercise, means of really learning and experience selling covered options.
Okay, so we got about 80% of the people have voted. So I'll give you another second, and then I'm just going to close the poll. Looks like a couple people are saying they haven't because they haven't had the time yet.
Can't help you with that one.
Yeah, we all have that problem. And I guess it doesn't work on a Mac. Somebody's saying it also doesn't work on a Mac. So Looks like a little more than half of the people have tried using it, which is great.
Let's see, on the Mac, the virtual trading system does require Flash, and a native Mac doesn't have Flash installed, but you can install Flash on a Mac. I would assume if you did that, then it probably would work. So whoever it was that had the Mac, if you try installing Flash, if you don't have it, maybe that'll solve the problem there.
Yeah, because somebody
And
else is saying it does work on their Mac. So.
yes, so that's what I was going to say is, and it may be an issue. I have seen on the PC side that current version of the virtual trading system won't work with Chrome, but does work with Firefox. So the same thing on the Mac. If you found it wouldn't work with one of the browsers, be it Safari or Chrome, you might want to try Firefox, and that might cure the problem. And make sure that you have Flash installed.
We actually had 88% of people voted, and 53% said they were using the simulator, and 47% said they hadn't yet. So a little over half, so that's great.
Okay, well, again, real quickly, if anybody's got any other questions, we've thrown out some ideas on some things that might be a problem, but if you've got any other questions, throw those. We don't necessarily have to wait for the questions, but if you have concerns or issues, let Lori know and we can maybe cover them a little later. So with that, let's move on. Both Susan and Etana provided some stock names that they wanted to look at, and I think I'll start here with a couple that Susan had suggested. The first was ticker was DVA, which is Davida Inc. Okay, this was a October 20th, and the strike was a $90 strike, collected $1.33. I don't know if she told me contracts. We're going to assume one for now. And the date sold was August 15th. And what this is saying is you could buy it back for less than or for $1.09. In this case, the $1.33 looks like it was only about a 7% APR. So this isn't necessarily one I would have put on based on my trading rules of trying to achieve a 20% or better APR. And that may be why it's so close, the $1.09 versus the original. If we go look at our option chain, and we're looking at the October, this is the $90 put. It looks like it's asked at 40 cents. There is no bid. Oh, yeah, I'm sorry, that was September. The October, which is what she did. Let's do this right. $90 is 70 cents at $1.05. We could put in the $1.05, and what that would tell us is, you know, we essentially are flat with our original, so we wouldn't want to do that. If we could buy it back at 70 cents, it says we'd net about $33, and our APR would have been 6% for that. So again, some of this isn't necessarily one, you know, and I'm not trying to be critical of Susan. If you know, she may have different trading rules, and this may work for her. It isn't necessarily one I would have put on, and I would have been trying to find a better opportunity with the cash that I had available. All right, let's look at the other one she asked about was Polaris, PII. And let's see, this was a September 22nd expiration. Right. Strike was $70. It's sold to open at $1. Again, I don't know, we'll say one contract. I think she said she did it on August 17th. The tool is telling us, Now in this case, this was a little better APR. This is about 12% when it was done. The buyback would be less than 20 cents, so let's go out and see what we're currently at. So puts, make sure we're on September. We are. So September $70 puts. Our bid at 40 cents, ask at 50. So we could put in our 50 cents and see what that looks like. And that says, and again, because of the high commissions, even though that 50-cent premium is half of the dollar that we did to begin with, because we're paying essentially $15 on the front end and $15 on the back end, we're only netting $20 on this trade, or 5% APR. So I wouldn't want to do the $50. If we looked at the 40 cents, the kind of current bid, then we're netting $30. Still not great. So I'd probably be continuing to hold and watch for a better opportunity to buy back. So that was Polaris. If there aren't any questions, we'll look at a few others. Atana had a couple. She asked about Home Depot, and she was looking at September 22nd, and it was a $50 strike and sold a premium of 35 cents. She did 2 contracts, and I don't know that I have dates sold. For argument's sake, let's say it was August 22nd, last Cool Club meeting. And so tool tells us that we'd want to be under 19 cents. If we go out and look, the $50 put for September is 5 cents at 6 cents. So we could put in 6 cents, and we could see that in this case it's going to cost us $27 to buy it back, and we originally collected $55. Now, we didn't talk commissions, so Itana may have significantly cheaper commissions, so it may look better than this. But it looks like she could close it down and kind of get the same APR as what she originally had and free up the cash, so that might not be a bad thing to do. Let's see if there aren't any questions on that. We'll look at Questcor Pharma, which is QCOR. Again, this was a September 22nd. The strike was a 43 put. Collected 60 cents. It was 3 contracts. Again, I'm not sure on dates sold. We'll put in the last Cool Club meeting. So the APR when sold, if it was that date, was like a 15%. If it was like last Friday, that APR is actually going to go up and would be like a 21%. So again, this could have been very acceptable from our trading rules. And we need to be under 18 cents if we go out and look at the chain. So Questcor Pharmaceutical, we want to be looking at the Septembers, which we are. And the 43 put is 30 at 45. And that's a little higher than our max, but we could again put in $45. In that case, we're only netting $15. Our APR is quite a bit lower, so probably don't want to do that. But we could look at, well, what if I could buy it back at like 30 cents? And in that case, then you've got a decision making. Am I happy to go ahead and bank the $60, be done with it, free up my cash, and again, less than a week in this case, and I still have 17 days left. So here my APR is improved for the amount of time that I actually have had it on. So if I could do 30 cents, maybe I'm interested.
I guess Itana said she sold 2 contracts on August 14th.
Okay. Okay, in that case, again, this is a lower APR than what I like to try and shoot for. And so if you could buy it back, and notice that the ask or the maximum premium dropped to 16 cents, and that's because we're doing 2 contracts instead of 3, and so that $15 gets spread only over 2 rather than 3 contracts. And you can see if we went to 1 contract, it actually would drop it down to saying you need to be under 8 cents. So number of contracts can factor into this fairly significantly, especially where you've got high commissions rates. Well, real quickly, what I'd like to do is there was one other, Malcolm had asked about looking at selling puts on Fastenal. So we're going to go back over to this sell to open side and put in Fastenal and walk through this real quickly. So has the stock gone down for a while? We'll bring up our chart. And what it looks like is it was trending down, but kind of end of July, beginning of August, we're probably bottoming, putting him in a bottom, and it looks like it's starting to turn and move up. So that's a close one. I might say maybe yes. We'll say yes. Is the stock down on the day? Yes, actually it is. Is the market down on the day? Yeah, today was kind of a mixed bag. Some of the indexes were down, some were up. So we'll say yes, it is. How much cash is available? Let's say we've got $5,000 to play with. Your maximum buy price. Malcolm didn't provide that, but I real quickly said if we assume the analyst's growth rate of about 17.5%, then I'd have a buy target of about 38 on Fastenal. Do I feel like the price will go up? Yeah, we've already seen it kind of starting to turn, so yeah, I definitely feel like we're starting to maybe move back up. Next earnings date, we can go see what that is. And it tells us October 11th. And it tells us that for the September premiums, we want to be over 54 cents. And if we're in October, we need $1.19. So let's quickly jump out to our option chain. And we are on September here. And so we were trying to get down here. Yeah, this is puts, sorry. We were trying to get down into the $38 range as my buy target. We can see those are not going to get the job down there at kind of 10 or 15 cents. If we were happy with a little higher buy price, you know, we'd have to be up in the $41 range before we started seeing pretty decent returns. So if we set a 41 of September and a premium of 50 cents, and one contract tells us we aren't quite to our 20%, we're an 18% APR. Obviously, again, if we are looking at doing, let's say we're going to do 3 contracts, let's have a little more money available. And we say 3 contracts, now all of a sudden we're over our $100 that we're trying to collect, and our APR is 23%. And that's all from just leveraging that commission across 3 contracts instead of just 1. If instead we wanted to look at October, so the 38s are 60, 70 cents. It's said we needed more like $1. I could maybe do a 40 and try and get $1.15. So if we put a 40 in and we move this out to October and set $1.15, then we are in fact above the 21%. And the reason this says I need $1.19 and we're at above 21% is portion 2 doesn't know how many contracts you're going to do when it's giving you this recommendation, so it assumes one contract. If you do more than one, you'll be able to go with a little lower premium and still be above a 20% APR. If we put 1 in here, you'd see we actually drop below a 20% APR. So Malcolm, I hope that helps on Fastenal, gives you a little idea on kind of what it might look like. And I'd say it's close. Kind of depends on what you have as your acceptable buy level. If you truly were trying to get bought at kind of 38, like I had using the analyst's growth estimates, then maybe it isn't quite there. But this market's a little bit of a roller coaster, and you might get another opportunity to sell puts down closer to the 38 or maybe even lower range. So it's definitely one worth looking at or keeping in mind. So with that, we're close to an hour, and I think we've gone through most of them that got recommended out of the discussion list. I really appreciate people taking some time and effort to throw some out there. I think it helps everybody when you do that. And I hope this has been useful for people to see some other examples. If we don't have any other questions, Lori?
There were just a couple things.
Okay.
Tana had said she had problems with the Mac and the virtual simulator, and Teresa had sent some input. I don't know if people saw this in the question box, but apparently she got a lot of help by calling or emailing the Options Industry Council, and they're very helpful. And she did get it to work on a Mac, so that's an option there if there is a problem with using that virtual trading simulator.
Great.
And then just another comment a little earlier, Sharon had just asked, do you ever look at short interest for a stock when you're trying to decide if it's a good opportunity to sell an option?
I personally don't, but I know a lot of people do. How's that for a mixed answer? And I don't know that we've got time to go into what that means and some of the nuances of that.
I actually just posted something on Club Cafe today about what short interest is. So if you go to our homepage, you'll see the Club Cafe, the link to that, if you're curious.
Yep. I think that might be something that will fit nicely into our discussion around volatility at the end of the month as well. So maybe that'd be something to hang on to for that. And so if there isn't anything else, I appreciate everybody joining us, and I hope these continue to be sessions that are worthwhile to everyone, and I'm enjoying doing them, and as long as you guys enjoy seeing them and I enjoy doing them, we'll keep doing them for a while. And with that, say good night.